Good morning, everybody. There's a lot going on out there, so let's get to it. As you can tell from the backdrop, I'm traveling. The thing about our job is you can do it from wherever in the world right now. And if you see what happened on Friday, you deserve some explanation of what happened and not just oh yeah, let's just hang in there. It always comes back. Let's talk about what happened and what it means to you. And I've got notes here, so if you see me looking at them, there's a lot to go over. So let's start with this. Nothing fundamentally changed in our bull case about commodities, natural resources, precious metals that are going to go up. It's not as if there was a massive new discovery of gold and silver. It wasn't as if suddenly we balanced the budget or peace broke out in the Middle East or silver stopped being a strategic asset. None of that changed. The second thing is this: the bull market is still intact. And for those of you who have been with me for a while and Walt, you understand bull markets have three distinct phases. Remember, a bull is one that's basically going up. Phase one is quiet buying. Think of it as a baseball game. In the first three innings, what happens? Usually rich people who are really wired see an area to invest in that is cheap and low, and they know something's going to happen, so they begin to accumulate. And they don't tell anybody, but what happens is their investments at some point start to push the prices up. At that point, we enter innings 4, 5, and 6. Wall Street gets involved. And Wall Street is not content to let something rise gently. Oh, no. They've got to trade it. These are the innings we're in now. We get 2 steps forward, 1 step back. And the 1 step back is pretty violent. I mean, it's a big thing, and it keeps the public out. For those of you who have been with us for a while, you're veterans of this now. Although Friday, that kind of took the cake. That was a big one, and we'll get more into detail on that later. The last 3 innings, meaning 7, 8, 9, the public finally gets comfortable with the pattern. What was 2 forward, 1 back was too volatile for them. Suddenly, hey, look at this. It keeps going up, up, up. Well, when they get involved, then we start going straight up. That's actually your danger time, when there are no corrections at all. So what are Walt and I looking at right now? In the 2 forward, 1 back, you want every high getting higher. But more importantly, when it corrects down, you want the low to be higher. That channel is still very much in effect. So a normal correction in a bull market, yes, although this one wasn't quite normal. And again, we'll get to this. Next thing on my list, perspective. If you go back to your January 1st statement and you look at February 1st, most of you are still ahead for the month, even after what happened. And all of you are ahead from December 1st to February 1st. So it ran up really high, mid-December through late January. And then this beat down, you're still money ahead. Thus, the channel is still in place. Next, who did it and why? This one's pretty easy to discern. The smackdown came from what we call bullion banks who were on the wrong side of this trade. So we've talked about short positions before, but quick recap. On Wall Street, you can make money when something goes down. That's very foreign to us. We think you only make money when prices go up. But basically, think of it as a bet. I'm betting the price will go down. Well, if the price goes down, I win my bet. What if you had the ability to push the price down and almost automatically win your bet every time? Wall Street has this ability. What they can do when they want to is they can flood the system with what we call paper futures contracts that appear as if there's supply. So imagine you could supply 100 million ounces of gold to the market just like that with paper. That's not real. It's a futures contract. But to the market, it looks real. If suddenly you have far more supply than you have demand, you can push prices down. This is exactly what we saw on Friday, but it was to a huge degree. And here's why. All those guys who had been betting short in October, November, December, into January, as that price continued on precious metals to go up, 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 they were getting creamed. They needed a way out, and they needed a way out by month's end before the regulators came in and said, hey, wait a minute. The losses that you have on these short positions, These are astronomical. You were outside your parameters, blah, blah, blah. They didn't need that and they couldn't afford it. So what did they do? They slammed the price down. By the way, some tells in this thing. If this were a real panic, if the public were involved, you would have seen prices waterfall down very quickly. Well, there's a rule on Wall Street that if you have something fall within 5 minutes, 10%, they halt the trading. There was no halt on Friday. None. Wait a minute. This wasn't a panic. This was a controlled demolition. Every time it started to hit that 10%, oh, they let up on the gas a little bit. And then they pushed it down again. It was a grind, grind, grind. And right at the very bottom of the grind, guess who sold out of their short position? JP Morgan. Yep. And what did they do? They took delivery of silver. Now, who did they get it from? Well, they got it from someone who sold, someone who panicked. And that's exactly what they needed to happen. They needed to frighten everybody out so they could do what we call cover their short position. Mission accomplished. So was it a natural, organic supply and demand situation that pushed prices down? Now, it was manufactured. And it was manufactured by very powerful players who needed to get out from the short position. Again, back to nothing fundamentally changed. All right, so how also do we know that it was artificial? Now you have to look overseas, and this is another tell. What should have happened is if the price was falling in New York on silver from 115 down to 85, why wasn't the price falling in Asia? But we saw it in Shanghai, in Mumbai, in Australia, in Canada. The price for physical silver was between $120 and $140 an ounce. Well, wait a minute. If you're a trader on Wall Street and you say, wait, I can buy silver. By the way, same thing up with gold, but we'll use silver as an example. I can buy silver at 85, immediately flip it and sell it in Shanghai for 120, pocket this huge amount of money. Why didn't they do it? Well, the answer is they don't trade paper in Shanghai. They trade real physical silver. So if you decide to do that trade, you have to deliver silver on pallets to those guys. And that's the real world price. But they couldn't do that. Thus, we have this massive disconnect now between a New York price and a rest of the world price. So the question that Walt and I have to ask is, wait a minute, what's the real price? Is it this paper futures price, what they can obviously manipulate at will, or is it the physical world price where industrial users go to a refiner and say, hey, look, we need silver for our solar panels. We need silver for our electric vehicle batteries. We need silver for our cell phones to make the connections. Is that the real price? Or is it the paper price? Our belief is it's the physical price. So what's going to happen here? My guess is for the commodities exchange in America to have any credibility going forward, this price is going to have to start climbing back up to meet the real physical world price. Otherwise, the price setting mechanism is going to move east to Shanghai and to Mumbai, and we don't want that. By the way, people ask, is this legal? Yeah, technically it is. Where there's some maybe illegal parts of it that go on as they do this, as they spoof or they put in fake trades. Yeah, and Wall Street's been found guilty of this in the past, but yeah, they can do this. So what's to prevent them from doing it again in the future? Here's the problem. There is a cost to these takedowns, and JP Morgan indicated what it is. As we slam the price down, someone like Elon Musk says, well, if you're going to push it down to 75, 80, 85 bucks an ounce for silver, I'm taking delivery. And so what did we see at the end of the day on Friday? We saw institutional, no, better said, industrial buyers or banks like JP Morgan taking delivery of these metals and not just playing the paper futures game of is the price going to go up or go down. Here's what happened. A quarter of all the silver that was in the vaults at the commodities exchange stood for delivery. At this pace, if this continues by the end of March, we will be completely out of silver at the commodities exchange. At that point, there's really no paper silver to trade. There are no futures contracts because there's no metal. And the price will not be of silver or gold or copper or all of that will be set in the real world as buyers and sellers get together and determine what price is. That will be a slingshot move up. So what do we do? Our advice is take a deep breath. Look, this is the 5th inning of a 9-inning game. The bigger gains are coming. This was a desperation move by some bullion banks that needed to get out from a very bad trade. And yeah, they pulled it off. They didn't do it at your expense because we didn't sell. And so I hate to say hang in there because I hate that saying, but the reality is nothing fundamentally changed. This was normal for a bull market, and the trend is still with us. So Walt and I are watching out for you. And by the way, what you're invested in, we're not invested in paper futures contracts. What you own, the Sprott physical gold, the Sprott physical silver, they own real gold and silver in vaults. They don't do the futures. They don't sell more shares than they have ounces. So you're in the right things at the right time. And with that, I'll turn it over to Walt.